Hey, good afternoon, traders, and welcome back to the channel. Today we're going to look at HIMS. Ticker symbol is HIMS. And if you'll recall, the last time I posted on this, we were actually in the middle of this breakout. It looked so promising. We had this move up, then we had this bullish consolidation, and I was posting right as it was breaking out. Well, clearly that turned into a massive bull trap that unfortunately I was caught in, and here we are today. So I want to look at this under the lens of kind of where we are at the macro picture. And I want to show you some things I'm seeing in the charts that don't look so bad. So before we jump into this chart, I want to transition over to this platform hub. It's something I like to look at because it has a built-in Elliott Wave modeling system. So you can look at it through the lens of Elliott Wave. And if you do that, and again, super clean chart, no drawings on here, what you can see is, at the end of the day, we're in a massive bull flag. This consolidation is bullish until proven otherwise. And we are right at the bottom of it right now. We're going to walk through some of that right now. But why I wanted to transition back to this is I want to show you we are essentially in an A, B, C. So this is a complex correction in Elliott Wave. So as long as we hold this level, we'll talk about that in greater detail in just a second, this is just one massive bull flag and we are in a consolidation range. Okay, so let's go back to this chart in Trading View and let's apply some trend lines that we previously had on the chart. And let's also apply some demand zones that we had previously had on the chart. And I want to kind of walk you through where I see us currently. So first things first, if we kind of go back in time and we look at this move up in the context of it, we had this descending broadening wedge. It broke out, failed, wasn't ready, came back in, retested this demand zone for a double bottom, which also looked very, very encouraging, very bullish. We had our move out of that descending broadening wedge, created this bullish consolidation that again faked us out in terms of a bull flag. And now what happens on moves that don't materialize in the direction they should? They often and most often result in a more aggressive, larger move to the other side. And that's exactly what we got. Failed move, bull trap, sold right through the bottom edge of this consolidation zone, went down through it, retested the breakout of the descending broadening wedge, retested it here, looked like it could be promising to make a move back and resume and potentially form a bear trap. It did not. It rejected the 50-day moving average, and we retested it for a second time, tried to make its move up, and now we've found ourselves back into the descending broadening wedge. But there's some things I'm seeing that I want to show you in terms of what this possibly can do. So if you're in this position, stuck in it kind of like I am, you're really going to want to look at areas to dollar cost average. And that's exactly what I want to show you. So there's some areas that need a hold to really solidify the fact that this is bullish consolidation. If it does that, I'm going to walk you through the different scenarios. We're in nothing more than just a large corrective range, right? And that's what Elliott Wave is suggesting. So what do we have here? Let's kind of zoom in. First things first, I'm going to make this a little bit larger. So we have a move back into the descending broadening wedge. And you can see we had on Thursday somewhat of a bullish candle, had a little lower wick, still, kind of neutral, but nice down at the bottom of end of a range. And then on Friday, look what we had. We had another hammer candle, and it saved us from confirming below this back into this wedge. What do I mean by that? In order to confirm back in the wedge, we would have actually needed to close below 4103, and we did not. That's the low wick tail of the daily candle. We did not. We formed another hammer candle, closed right on the demand zone. So this looks constructively bullish, that I do think we're going to resume movement back up to the upside. So some things obviously have to work in our favor. We have to get a move back out of this without confirming below. If we confirm below, then we are set to go lower. So I want to walk you through scenario one, which I think is the most likely scenario, which is it holds this demand zone and we make a move higher from here. So maybe something like this, back test it, break out, back test it, and then start our move higher. Now, what you're going to want to be looking for on this move out is you're going to want to move above it, and then you're going to want a confirming move above it. If we get that, then it suggests we can either go higher from there or we can back test back to the demand zone. Now, I'd actually like to see it come out, confirm, and then retest this demand zone and then make its move higher. That would set up a very, very powerful move, kind of like this, to where we had a W. If it did something like that, that would be another W, another double bottom. And that, my friends, would be very, very bullish. And that's one thing I'd like to see. Now, could it just ignite out of here and just go much, much higher and do something like this, right? Sure. But I don't want to see that. I actually want to see this double bottom and retest that. So that would be the most bullish scenario for us in terms of a longer term sustained breakout of this bull flag and take out these previous all-time highs, which I do think it's going to do. I think it just needs to consolidate and do some of this work. Okay, scenario number 2 is we fail this move and we break down from this larger bullish structure. So let me just draw on the bullish structure I'm talking about. And it's essentially this. So you have that up there, and then you have this kind of low here. And, you know, it's going to, obviously, it's going to blend in because you're in this demand zone. But basically, all this is just bullish consolidation. So I'll take that bottom one off. I'm going to take this top one back off. And now, so scenario 2 is we fail this, we break down, and then what would that set us up to do? Well, that would set us up to do something like this, right? Say we move higher, but we fail, and then that would set us up to target this demand zone down here. This would take us down to the 34, 35 range. Now, this wouldn't be the end of the world. It could just be, you know, a bear trap similar to this that could explode us higher. So if we do something like this and we don't go with my scenario 1, scenario 2 takes us down into this 34, 35 range, which is a back test of this previous high here, of this breakout. So again, still bullish. And what I want to do is I want to throw on a Fibonacci retracement, okay? From this low here to this high. And I want to show you a couple things. So the first thing is right now we're in the golden pocket. We're in the 0.618, 0.65. So this should hold and could hold. And that's another reason I like the first scenario 1. But if it fails, what are we going to do? We're going to come down and we're going to target this 0.75, 0.78 level, which is, again, just another fib level down below. So I expect it to be supported here. If we fail that and we do something like this, scenario 3, so scenario 3 could be something like this. Now, this would be pretty major and set us up for a move down to the 24, 25 range. So you have to prepare yourselves for all of these different things and be able to react and have a plan. Most important thing you could do in trading is have the plan. So you want to look at it through the lens of the bullish side, the bearish side, especially if you're in a position. Know where it can go, know where you are going to dollar cost average, and know where the opportunity is that provides you with the greatest opportunity, you know, for continued, you know, a move in your direction. So the way I'm going to play, obviously, is, again, this scenario 1 would be ideal. Won't be adding here at present because I've already added kind of right here when we hit the 618. Well, I won't be adding any more, and I will add, however, on this back test. So if we come out with scenario 1, we back test, we break out, we back test here for a double bottom, I will add there, most certainly. Now, if we fail here, my next add level will be at this 34, 35 range, and the last add level would be down here. Now, each of those scenarios, as they would play out, would provide excellent entry points for that dollar cost average and would help to keep your dollar cost average close. Because at the end of the day, that's what it's about on a swing trade basis. It's all about managing your position so that you are close to your position. Dollar cost average is close to current price. That way, when it snaps back in and moves in your direction, you can take a 10%, 15% win and get out of the position, maybe take half off the table, maybe at break even, and then look to dollar cost average lower. Again, it's all about position management. It's all about having a plan. So that's really how I see this potentially playing out. Now, with that being said, once we do break out, let me take off some of this and clean up the chart a little bit. let's take off some of these levels, and I want to show you how you can measure the breakout of this bull flag. So a couple different ways. First way we're going to do it is with a time-based extension, or a trend-based fib time extension. So the way you calculate that is you take the low from the local pivot low there, you take it to the high, then you take it to, oops, that is not the one I wanted to do. That is the wrong one. We're going to switch to the correct one, which is trend-based fib extension. Okay, so let's redo this. Going to take it from the low, take it to the high, and then let's assume that this sets our low. Okay, this sets our low, and it's scenario one. Okay, so if that happens, then here are your levels. Here's going to be your first target, which is basically just the top end of the range. Then you're going to have the 100% based, or 100% move, which would take us to about 85.83. Then you'll have this target at 96.79. Then you'll have 103.57, and then your 150 puts you at 109. And then lastly, if it gets really bullish and really crazy, you can extend to the 161% extension, which would take us all the way up to 114. But that obviously would take a lot of time. The other way you could calculate this is you take your flagpole from the low to the high. Let's assume the breakout range is right here, and that puts us again, into those areas. So the puts us in the 103 to about the 109 range. So again, a lot of things have to happen for all that to come true, right? We have to basically hold this, get back to the top end of the range, and truly break out for all of that to come true. Do I think it could happen? Absolutely. I think it will take time to happen. But this, my friends, is definitely bullish structure, provided we do not break this and go to these lower levels. Again, if we do those types of things, then it just becomes a much larger range, and you have to watch price play out. But that's my thoughts on HIMS. That's where I see price currently at, where I see it ultimately going. And if you liked this analysis today, make sure you smash that like button, show some love for the channel. Subscribe if you're not already subscribed. I try to do my best in bringing you not only technical analysis as it unfolds, but then, in scenarios like this where a trade potentially can go against us, and we just have to manage the trade. So hopefully I did some, I helped you guys kind of learn how I analyze the chart, and this technical analysis was valuable. And again, if it was, please hit that like button. And I'll remind everyone, no financial advice given, always for educational purposes and to share with you what I do with my own trading portfolio. Okay, guys, thanks for tuning in, and I'll see you guys on the next one. Take care.